I'm seeing some other people here. Awesome. That's great.
Good.
What do you think's going on?
I'm not sure, but I'm not live. There we go.
Okay. Okay. Okay, looks like we're ready to go here. I think we're going.
Start over.
Okay. Hey, Faith. So I hope you can see us this time. We're so glad to welcome you to our first ever live YouTube event. It's Homebuyers Welcome, and we're really glad that you've decided to join us. So welcome. My special guest tonight is Dustin England with Motto Mortgage. And he is a 10-year veteran of the mortgage industry, and he works in Linwood, Washington, and he is going to tell us about all things mortgage related. Dustin, how's quarantine been treating you?
It has been about as exciting as it has been for everyone else. I've been working from home and getting very proficient for my home office. I did actually move about a month ago, which was exciting during quarantine, but it's been good. I am excited for things to start opening up. It looks like we're starting to get that way,
Yeah,
but
right.
yeah.
And you're back working in your office this week, right?
Yes,
Oh,
as essential employees, we did
yeah.
get to work in the office this week,
Great.
so it's nice to be there. It's still a little bit quiet,
Yeah,
but
I imagine so.
it's a step in the right direction.
Exactly.
How about you? How have you been holding up?
I've been doing good. I usually work from home out of my she shed, and so, that's not really changed for me, but I do miss going in and interacting with people, and of course, things really are different. We're not essential employees, but the governor has allowed us to do some real estate work, so that's been really wonderful. And I've been spending I've got a lot more exercise. I've been
That's
out
awesome.
taking walks and riding bikes and swimming in the lake, and so that's been
That is
really good.
awesome.
That's been a really good thing. Well, folks, we are here to share some interesting statistics about the local real estate market. We have world events going on, and they are impacting our local real estate market. And we are going to share 3 vital statistics that tell the story of how we're doing. And we're also going to talk about getting your offer accepted in a competitive market, and it does continue to be a competitive market. Dustin is going to fill us in on things like what went crazy with the interest rate. He's going to tell the story of how the interest rates have been impacted and how they're doing now, and also talk about the world of lending, the challenges, the current challenges, and exactly what's going on. And he's going to give you some really excellent advice on getting a home loan if that's what you're looking to do. So let's get started. First of all, we're going to talk about a stat that is very interesting in the real estate market. In the real estate field, we always talk about what we call months of inventory. You've probably heard it referred to as supply and demand. So when we talk about months of inventory, it's basically a calculation that we do that defines supply and demand in the real estate world. So right now in King County, we have 1.2 months of inventory. That means that if no new houses came on the market and we sold the ones that are currently on the market, it would take us 1.2 months to get rid of all of them. So in 2019, we had 1.9 months of inventory this time of year. So you can see that actually we have less inventory right now in King County. And then also in Snohomish County, you can see here that we have 1.1 months of inventory, so even a little less supply than in King County. And last year at this time, we had 1.5 months of inventory. So what this means to you is there are less houses available to buy. And it's kind of understandable because with the we still have people who need a home, and we have folks who would like to sell their home, but they're nervous about letting strangers into their house. So of course you are going to see folks holding off putting their house on the market. So we did actually, this isn't one of the stats I have to share with you, but as a result, we do have about 30% fewer homes going on the market this month, April 2020 versus April 2019. So the months of inventory does show that it's still a seller's market. Anything less than 3.1 months of inventory is a seller's market. So as you can imagine, there's still a lot of competition out there, which is why I want to talk to you tonight about what you need to do to get an offer accepted in this market. So then let's go on to stat number 2 that's really important. Average sales price. So as you can see from my chart here, I've included 3 years of statistics. And you'll notice that in 2018 in King County, the average sales price was $806,000. And in 2019, it was $810,000. And then in 2020, $867,000. So you can see that the prices are not falling. And that's actually a question I've had from a lot of folks. People who own a home, they're saying, are the house prices falling? And I think a lot of times they're looking back to 2008 and they're worried about that repeating itself. So these are the figures from March in King County and in Snohomish. In Snohomish, of course, the average housing price is lower than King County. In 2018, it was $525. In 2020, in 2019, it was $539. And then here in 2020, it's gone up to $576,000. So these are the March figures. I'm just trying to give you a couple of months because this pandemic has impacted multiple months. And then in April, we have 2018, 846,000, 2019, 830,000. So you saw a little bit of a drop there in King County over those 2 years, and then a little uptick in 2020 from the 2019 number. And in Snohomish County, 544,000 in 2018, 573 in 2020, and 541 in 2019. So what you're seeing is the housing prices they're really steady. They're not plummeting. And you know, Dustin, I know you've been in lending for quite a while, so you lived through 2008. You know kind of what's going on here. And we don't see the same situation, do we, that we had in 2008?
No, we don't. We are in very challenging times, and certainly there's a lot of question marks out there. But in 2008, what really drove the collapse of housing and house prices, it was the mortgage market. It was very risky loans. It was, and people not making the payments on those risky loans because they couldn't. And that created a domino effect, which really collapsed the world economy. What we're seeing now, especially here in Seattle, is the house prices, they're really still demand driven. Mm-hmm. We have large employers still bringing in a lot of people, and they're generally very good employers. Mm-hmm. They're high-paying jobs, and people want to come in and live in nice neighborhoods and live the American dream. The lending fundamentals leading up to our current situation with this pandemic has still been very, very solid.
That's good, yeah.
There's been very little risk in the loan up until in the mortgage industry up until March changed things some, but yeah. We'll talk about that a little bit later. But we expect that house prices will remain steady.
And I think too, don't you think that the fact that rent is so high is another indicator in our area that it's a housing demand that's really what is supporting our housing prices?
Yeah, it really is.
Yeah.
And we're often seeing that people can buy a house for less than what they're paying in rent.
Exactly.
If we really run the math on it. So,
yeah, right.
It is demand driven.
Yeah.
And they're just not building houses fast enough around here.
Yeah, and they're not making any more new dirt. So, yeah, so no place to build. Okay, so the third statistic that I want to talk about is days on market. And this is, in a nutshell, a days on market statistic is you put a house on the market, how many days does it take for the market to respond to that house and say, I'll buy that, and for the seller to receive an offer and accept it and move towards closing on that sale. So this is a very interesting statistic because in March of 2019, we had in King County 45 days on market and in Snohomish County 52 days on market. And that was actually a really high statistic for that year. But I don't know if you think back to what happened last spring, we had what we called Snowmageddon. And it's interesting to me that the snow had more impact on the days on market than this pandemic has had. Because in 2018, if you go back and you compare 2018 to 2020, 2018 in King County days on market 24, 2020 30, 28 in Snohomish County 35 in 2020. So really statistically not that significant, the change. And then in April, you have almost very similar numbers. So in April 2019, we were still recovering from the Snowmageddon. We even had snow on April 1st. I don't know if you remember the April Fool's Day snowstorm. And then 2018, the numbers were 17 and 20 for King County and Snohomish County. And in 2020, 20 days and 22. So our market is fast. When you put a house on the market, we do have low inventory, and we still have buyers out there trying to buy houses. As a matter of fact, recently, I had been showing a gentleman homes for quite a few months, and we hadn't found what he was looking for. And then finally, in I believe it was April 5th, he found the house that he wanted, and it was just the perfect house for him. And I went back and called the listing agent and said, I'm going to write an offer on your house. And she said, well, just so you know, we have 7 offers already, and they're all over list. So that's a competitive market, and we were able to get him that house. But it's the idea that the housing prices are falling and that there aren't any buyers out there just isn't true. There are still, and the buyers that are out there are motivated, serious buyers. Okay, so moving on, I want to give Dustin a chance to talk to you a little bit about interest rates, because interest rates, people are really interested in interest rates right now because there's a lot been going on. So Dustin, give us the inside scoop.
Well, it has been a very interesting time to be in lending. I guess there's never really not an interesting time, but the last 2 months have been challenging and interesting, but we are seeing the recovery start to happen already. But really what happened as we were going into late February, early March, we were seeing record low interest rates in the conventional and FHA. We're in the very low 3s, if not 3%. And then all of a sudden, COVID happened. And we literally, the first week to 2 to 3 weeks of March, we saw interest rates go from about 3% on a conventional loan up to as high as 4.5% to 5% in 2 weeks. And if anybody follows interest rates, that's a massive shift for that amount of time. And so what happened? First of all, if you recall, the Fed also came out during that time and said they were going to cut interest rates. So why did interest rates go the exact opposite way of what the Fed said they were doing? One thing a lot of people don't really understand is the Fed, when they say they're cutting interest rates, that means the federal funds rate. And that's the interest rate that banks borrow from each other at and that people borrow from the government, or banks borrow from the government at. The mortgage industry is really driven by the MBS market, which stands for mortgage-backed security, and that's a bond that is supply and demand driven. Very briefly, when we originate a home loan, a lender takes a bunch of those home loans, they package it up, and those get bought by Fannie Mae, and they securitize that and they sell that to the bond market, typically to large institutional investors like life insurance companies or large pension funds, things that are very low risk, and basically there's a guaranteed return on that. Large annuities, things of that nature. So the MBS market really had about 3 things happen to it. Lending in general happened these first 2 weeks of March. The first one is the government came out and said they were going to shut down the economy. So they said if you're going to lose your job and you can't make your payment, you can put your loan into forbearance and we're not going to ask why. So again, when people make their monthly payment, a lot of people don't understand this. If they're paying their payment to XYZ Bank, the bank doesn't keep all that money. They have to pay these bondholders that I just described. Those payments still have to be made whether they collect that payment or not. The property taxes still have to get paid whether they collect that monthly payment or not. So when the government comes flat out and says, you guys don't have to make your payments, all of a sudden lenders are left holding the bag where they have to make payments on these large servicing portfolios, literally billions of dollars, and a lot of their revenue stream is going to be cut off. Thanks to the safeguards that were put in place after the collapse of the mortgage industry, lenders do have significant reserves, but that only lasts so long when you have upwards of, say, 20% of the population not making their mortgage payment. I don't know exactly what that statistic is right now of who's in forbearance, but that was the fear is, oh my gosh, how many people are going to go into forbearance?
Right, yeah, that makes a lot of sense.
The second thing that happened is the economy shut down very quickly. A lot of people lost their jobs. Job loss equals risk in the mortgage business. So what happened to interest rates during that couple-week period is nobody knew how this was going to pan out, and actually we're just now starting to see how this is panning out. So this unknown risk has been priced into the mortgage industry for really about a month, and we're just now kind of seeing this stability come back into interest rates, back down into the lower 3s, and kind of just lenders are starting to take a breath and say, okay, things are starting to open up. It's not going to be, we're not going to totally collapse the system, which really people were talking about for several weeks. And then the last thing that happened is the Fed came out, and again, without getting into a lot of details, when all this volatility was happening, they came in to help, and they said, we're going to start buying mortgage-backed securities to stabilize the market, which is a tool called quantitative easing. They used it a lot to recover from the housing crisis over the last 10 years. And what they did, though, is in the first week, they bought $200 billion worth of mortgage-backed securities unexpectedly. And that, without getting into a lot of details, is when we protect a loan, lenders have to hedge that to protect themselves from losing money. And when the Fed came in and did this, all the protection that they had put in place went out the window. So they lost a lot of money.
Yeah.
Again, the industry has come back and talked to the Fed, and now the Fed said, okay, we'll do this a little more gradually. So what does this mean? It means that with all of these factors happening all at once in a very short time frame in the month of March, there was a massive cost added to lending, and there was a tremendous amount of added risk, which also adds cost. And it took lending several weeks to kind of plow through this. Some people, some lenders, we're a broker, so we shop different lenders all the time. Some lenders still are in the high 4s. They're not going to price that loan. They just aren't ready for it yet. In general, we're seeing rates get back down to bond markets are very favorable to where interest rates should be right now. And we're seeing rates stabilize, get back into these mid to low 3s, maybe a little bit lower than that, and really get back to where we were at the end of February, early March, before the bomb went off, if you will.
Yeah, right. And would you say it's fair to say that it's still true that the better your credit rate is,
Absolutely.
the more you can qualify for a lower rate? I mean,
absolutely. And we're seeing that more so now. With the added risk in the market, some lenders are choosing to not lend to lower FICO scores, or if they are, they're going to earn an increased premium because there's more risk to the lower FICO score borrowers.
Yeah.
So it's very important if you're looking to buy a house right now to really work on your credit, pay down your credit cards, and really talk with a mortgage professional to see what the best way to get your FICO score as high as you can get it.
Right, that's great advice. And then we have kind of a hard question for you here, Dustin. You can answer this for us. This is another thing people want to know. Is it harder to get a home loan now?
It's a very loaded question. The short answer is, for some people, yes, it's going to be a little bit harder to get a loan. Rolling up through February, it was easy as a mortgage broker. I could say I can get a home loan to somebody with a 580 FICO score.
Right.
I can't say that anymore.
Right.
Right now, generally most lenders want at least a 640, and some want a 680 FICO score. Again, and it all has to do with this unknown risk. So people who are very well qualified, take care of their credit, and they have some cash in the bank, it's going to be more inconvenient than more difficult.
Right.
And by inconvenient, I mean lenders have put other stopgaps in, like it used to be they would verify your employment 10 days before they could fund the loan. Now they want to do it the day they fund the loan, because people have,
they're losing their jobs.
People, we're losing 3 million jobs a week right now.
Yeah.
So for self-employed borrowers, it's gotten trickier still. We're seeing lenders that now want more reserves. They're taking their average income and they're decreasing it by 25% to account for a disruption in income that's brought on by COVID. We're seeing that, where it used to be they would take an average income, now they want a profit and loss for the most recent month to show that they still are in business. And this, while inconvenient, it does make sense from a lending standpoint.
Yes,
as they
it does.
really have to make sure that they're lending to qualified buyers so that we don't repeat 2007 and 8.
Right. Agreed.
Another thing that has become a little more difficult, although it's still available through the state of Washington, is the zero down payment. There used to be more options nationwide for that. Washington State Housing Finance Commission still does have their zero down payment option. And we also have the VA loan still and a USDA loan still. Again, with some of these other precautions that lenders are putting in. But we still can do zero down. So those are really the big ones. The self-employed, it really is a little more tricky. Again, it's not so much more difficult. It is going to be a little more inconvenient, though.
Yeah.
Things
and
that used to
people
slide by.
are working from home too, right? A lot of them. So.
A lot of people are working from home, and really what the lenders are looking for is the continuity of income.
Right.
And they want to make sure that it's still going on when they actually fund the loan.
Right. That's awesome. Yep. Well, thank you for answering that hard question for us. And then we'd like to move on now to buying a house and what I call the home buying cycle. And there are a lot of pieces that are represented here by each one of these little wedges. So this is a kind of a high-level view of the home buying cycle. But the first thing that you would do really be when you go to buy a house is not call up a real estate agent and start looking at houses. You really have to start at the right spot at the beginning. And the beginning is to confirm the budget. It's just any time you're going to make a purchase, and this is definitely true with buying a house, it's the biggest purchase probably that you'll make in your entire life, is that you need to confirm the budget. And then define the home that you're looking for. It's a lot easier to find what you're looking for if you know what it is. And then to proactively search for a home, and then build an offer that will win. So speaking of confirming the budget, what is the process for getting pre-qualified? What financial information do you need?
Fortunately, that hasn't changed much. It's still, if you're employed, if you're salary or hourly employee, we're going to need to see your pay stubs and your W-2s. 1 month of pay stubs, 2 years of W-2s is standard. We need to verify where the down payment funds are coming from and how much you have. All of these things factor into how easy it is to get a loan and what that interest rate is going to be. We need to pull a credit report. And really what we do to figure out the budget is we take your credit report and we look at what liabilities are on there. We match that up with your income, And then we have debt ratios that are laid out by the government, in essence, you know, the agencies, that as long as you fit within these debt ratios, you know, we can get that loan. So whatever that monthly payment translates to, that equals your loan amount, and, and therefore your purchase price, depending on how much you have for down payment.
And I kind of know the answer to this already, but do you have to spend all that you're pre-qualified for?
Absolutely not.
Right.
You know, in some cases, we can qualify people for 57% of their gross income. You know, and it's, you know, for high income earners who have some other extenuating circumstances, no big deal. For people who are making $4,000 or $5,000 a month, 57% of your gross income doesn't leave you a lot to live on after that. This is an expensive place to live. So it really comes down to what the comfort level is, what you're willing to spend, and what that income level is.
Because at the end of the day, you live in the payment, right?
Right.
Not in the what you can qualify for. And you already answered the what if I'm self-employed, but with the self-employment, there was a time when you could do kind of like bank statement loans.
Yes.
And is that something that's on hold right now with?
So for self-employment, I didn't touch on it before, but we really need to see 2 years of business and personal tax returns. And one of the benefits of being self-employed is you have write-offs. Some people will write off their automobile. Some people write off, you know, depreciate things. Some people will write off costs of goods that maybe is a new couch for their house. You know, I'm not advocating that, and I'm certainly not an accountant. But it is an advantage of being self-employed. So sometimes someone who makes a good six-figure income, on paper it only looks like they make less than a six-figure income. And even though they can qualify, they don't on paper. So there are things that have been out, bank statement loans. They'll look at 12 months of deposits going into the business account, and they'll say, okay, this person actually does have this revenue coming in and this income. First week or two of March, all of that went away. Any of that kind of creative financing, bank statement loans, and some of our investor products, some of the jumbo loans that were available, not from banks, like through private lenders, a lot of that went away. We are starting to see that already come back. One of our biggest bank statement loan lenders, they're already back on board. It has tighter guidelines.
Yeah.
But it is available for those that qualify for it.
Right. And so with speaking of those kind of out-of-the-box situations, what about things like jumbo loans and stuff like that? Are they off the table, or?
Jumbo loans are definitely still available. Most jumbo loans come from banks or credit unions. So, and again, you've got this risk factor that's in the market. In some markets, more so than others. If you're a bank that caters more towards the tech industry, a lot of those people haven't lost their jobs.
Yeah, that's a good point.
So there may not be as much risk for them as there is for you know, a private lender that, you know, maybe has something with, you know, a union somewhere where maybe a construction project's been put on hold. So the jumbo market is there. On the retail side and in the broker channel, a lot of it has gone away.
Okay.
We are starting to see it come back. It's going to be slow. It's still available through the banks, again, with tighter guidelines.
Okay. Well, and just kind of on that note, I spoke recently with a friend of mine who works for a bank that does a lot of commercial lending, and she said that as soon as the builders were deemed able to go back to work, that their office was extremely busy with new builder applications for new projects. So I think that, you know, the builders are seeming pretty confident that they can go right on building and selling houses. So that was encouraging to me to hear her say that. Going on to defining the home, I want to talk to you about that a little bit. I know we have some folks on here tonight joining us who will be buying a house. And so I want to talk about the importance of defining a home. And to me, it really boils down to two really important things. And one is your wish list, or the things that you want to be featured in the home. But you notice that I have this other thing bigger than the wish list, and the little location marker, we're used to seeing that on Google Maps because it's location. So the tried and true statement that we've all made for years and years with real estate, there are three things that matter: location, location, location. And that's really true. And the reason why location is so important is because of things like your commute. Definitely in this area. Wouldn't it be nice if we could at least keep the traffic this calm?
Amazing.
I love it. I love being able to drive down to Seattle in 15 minutes. But, there's the school district, and sometimes folks just even want to live in a particular zip code, like 90210, right? Or was that show, the
was.
Beverly Hills? And then, we want to be in a specific county, or you want it to be rural or urban, walkable, things like noise level. So there's a lot of things that make the location very crucial. Sometimes you want to be close to family. So I think probably the biggest thing.
Sorry, we had a sound cut out. I think we lost the battery.
Oh, from here?
Just a moment.
I think we're having problems. With mine? Bear with us, folks. Maybe Dustin can talk about it. Location also really drives the price. I mean, it's amazing to me what you can get in Granite Falls versus Linwood.
Well, yeah.
Yeah.
Yeah, location is a big factor on what you can afford, always.
Yeah.
It's, I always joke that if I were to pick my house up and move it to Phoenix, Arizona, it would cost about a third as much.
Yeah.
And which, that's a big jump, but there is a difference between living in Granite Falls and living in Redmond, Washington, depending on where you need to be.
Right.
So, and that's going to affect, your lending.
Well, and around here, the traffic really is a big thing.
It's a huge driver of it.
I don't really want to sit in traffic that long. I am wondering if folks are going to figure out they can work more from home and maybe they won't.
Yeah, and it's really an interesting time as, it's to be determined of, how much prices of, maybe some of the more centralized areas may flatten, and some of the outlying areas may improve a little bit because of the demand. If people realize that they can work more from home, and they won't have to spend as much time in their car.
Can you hear me again? Let's see if I'm working. I'm having a little trouble with my mic, so can you hear me? Okay, awesome. All right, so I think we've talked a lot about location. So let's talk a little bit about the wish list. And whenever I meet with clients, let's say I'm meeting with a couple, and we're trying to figure out what kind of house we're looking for. We've figured out what the budget is because I always have my clients meet with a lender and know what they have to spend before we move forward. And then I sit down and I actually have two lists that have all kinds of different features, and I have the husband fill out one list and the wife fill out the other, and then we kind of compare notes. It's kind of fun, but it's actually amazing to me how often they really are on the same page. They both have, the same idea about how many bedrooms they need and how many bathrooms and all of that. And then I ask them to prioritize, because if you think about it, there may be some things you really want in a house, but some things, they're deal breakers. Like, for example, you might want a 3-car garage, but you could get by with a 2-car garage, and you definitely wouldn't buy a house with no garage. So no garage would be a deal breaker, but a 3-car garage would be more like, it'd be great if I could have this. It's more of a wish list item. And so we look at things like, how much square footage do you need? How important is a yard? What's your minimum number of bedrooms? Could you get by with 2 bedrooms and a den? What's your minimum number of bathrooms? Now, a bathroom is another example where you might have a wish list, like maybe you want double sinks in the master bath, but it wouldn't be a deal breaker if you found the perfect house, only it had just one sink in the master bathroom. And that's the sort of thing also that it's easy to fix, to upgrade. And I think that's one reason why location is so important, because I don't care how much you upgrade a house, you're not going to move where it's at. It's always going to still be in that location. But here's a couple things that people can tend to think of as deal breakers, but they're not. The color of paint. And I once went and showed a house to some clients, and there was a horrendous color of paint on the wall. And the listing agent had been wise enough to put a sign on the wall that said, "It's just paint." And I thought that was a really good reminder to everyone. It's just paint. So a lot of the decor and cosmetics and even the landscaping, there are so many things that you can do to a property. If it has the essentials, or what we call the footprint or the bones of the property are good, then there's a lot of things that really don't have to be deal breakers. But what we want to figure out is, what are your deal breakers? So we spend some time doing that. And we talk about, the location in great detail. A lot of times, if I can tell that folks' budget is really not going to go very far in the area that they want to look at, I will talk to them right away about, okay, you say you want to be in Linwood. How do you feel about South Everett? Or you say you want to be in Seattle. How do you feel about Mountlake Terrace? Because those are some places that your money's going to go a little further. Although Mountlake Terrace is hotter and hotter these days. And so once we've defined the house, we figured out what we're looking for, the next thing that we do is we begin what I call a proactive home search. And when you're going to be proactive about searching for a home, one of the biggest things is that we need to form a team. So the lender is part of the team, I'm part of the team, and the future homeowner is part of the team. And I want my clients to be looking at houses that I send them via the internet. I would love for them to be going to open houses and looking at things, looking at the neighborhoods, driving around looking at the neighborhoods that they want to live in. So being a proactive member of the team, it really makes it so much easier to find a house. But one thing I really want to bring out is that a successful search is about eliminating houses, not finding more. So I can't tell you, there have been times that, a lot of times you think you want to keep looking, and this is kind of coming into my head. I don't know if you've ever seen a Say Yes to the Dress episode where the woman has tried on 100 dresses and still can't find the right one. Well, you can get that way with a house too. So what I try to do is narrow it down so that we're really only looking at houses. I mean, if you say that you have to have 3 bedrooms, we're not going to look at a 2-bedroom house. And if you say you have to be in this specific school district, we're not going to waste our time looking at houses that are outside of that school district. So that's what I'm talking about, eliminating. We want to eliminate houses, although I have to admit, there have been times that I've shown a really cool house to a client who I knew that wasn't the house for them, but I kind of wanted to see it too. So we have gone and looked at it. But it is more about eliminating. And you wouldn't believe how tiring it can be to look at houses. And you get more confused if you look at too much. So so we really want to be proactive so that we're using our energies to actually look at things that might be you might actually possibly make an offer on that home. And it's all about you having input too. And then the next thing, I'd really like to spend a little more time on this, is that building an offer that will stand up in this competitive market. And like I said earlier, it is a competitive market. And a lot of times, I think folks can get the idea that, well, how hard can it be? The highest bid wins. And that's actually not always true. Many times I've been on the listing agent side of things, and I've been the one reviewing the offer with my clients, and I can tell you that the offer price is not the only thing that matters. You, as a listing agent, you have a responsibility to help your client choose an offer that at the end of the day will meet their goals. And the goal is always to sell that house, to close on the sale of the home. So you have to think about a lot of factors as part of that. So when I'm trying to help a client, I want to see things from the listing agent's point of view. And one of the first things I ask myself is pillar number one, funds. Where are the funds coming from? And then I'd like Dustin to kind of talk about that, because when you're trying to win over the listing agent and let them know that you have the funds, one of the things they ask you is they'll ask you about your mortgage broker. They'll say, who is this person and how long have they been in lending and what's their background? And so usually I'll say, well, why don't I have them give you a call? And what sort of thing do you usually say to a listing agent when you call them?
It's usually, I just want to put the listing agent, again, understanding what they're looking for. I want them to know that I've spent time with the borrowers. I've reviewed their entire portfolio, the entire vision of what their buying power looks like. They want to know that I've verified their income and their assets, and that there's really just no question that they're going to get the loan. So when I call an agent, I just say, Ms. Jones, I know you're looking at several offers today, but I just want you to know that my borrowers have money in the bank. I've reviewed their income. In some cases, I'll even send a file into underwriting to pre-underwrite it. If that's the case, I'll definitely let them know that. And I'll tell them, this has gotten an underwritten approval. I just, not to go too much into it, but I say, I've been doing this for about 10 years. I've got a very good feel for what loans are going to go through and what is not, and this loan is going to get funded. And then I talk about a little bit about the service and what they can expect from, generally me and Karen as a team. I also try to say, hey, you're working with a great buyer's agent. She'll take care of anything we need from our end, and we'll get this done very quick for you.
Yeah, that's awesome. And it's about selling the buyer as a borrower, really. And that is very reassuring when you're the listing agent and the lender calls you and gives you the lowdown on the buyer. You feel a lot more confident about taking their offer. Because at the end of the day, the last thing you want to happen is to take an offer, you get all the way down a couple days before closing, and then the borrower can't get a loan and the buyer can't close. And that is probably, number one, nightmare for the listing agent, because all kinds of things happen at that point. And actually the listing agent at that point can lose their client. That client may get frustrated and relist their house with someone else or decide not to sell. So it can be some pretty negative outcomes. So you want that reassurance.
One thing I would just throw in is, if you're actively putting offers in, or even if you're actively shopping, keep in contact with your real estate agent and with your lender. I've had it happen where I pre-approve somebody, don't hear from them for 2 months, and then they come back to me and all of a sudden there's just a purchase contract that shows up on my inbox, which is great, but then what about, okay, I pre-approved you for $350,000, so now you're buying a $350,000 condo that has $450 a month of HOA fees, and now I can't get that loan.
Really good point.
So just the biggest thing when you are actively offering on properties is communicate not only with your realtor, but with your lender too.
Yeah, that's really great advice, Dustin. Really important. So we really got to have those funds nailed down. And then the second pillar is fixer, which when you hear fixer, I don't mean fixer-upper. What I'm talking about when I say fixer is that you really need, another way to say fixer is a go-between, a mediator, or an agent.